our first session, which should have started about 10 minutes ago, is running from 8 a.m. to midday, 8 a.m. to 12. So that's our first session. Then the next session, which will still be today, will then run from 5 p.m. to 9 p.m. 5 p.m. to 9 p.m. Okay, so the sessions we had between 1 p.m. and 5 p.m. basically have been swapped and brought earlier to 8 a.m. to midday or 12 p.m. So I hope you take note of this. I'll keep repeating it along the way, but please note it somewhere that our sessions that were initially timetabled and communicated to run from 1 p.m. to 5 p.m. have now been brought to 8 a.m. to 12 p.m. So for today then, after we are done with this first session that will run up to 12 p.m., we shall then get the next session running later in the evening from 5 p.m. to 9 p.m. Okay, so I'm hoping that that's clear. Okay, fine. So today, session 2, we're going to still focus on section B. So again, we're going to still focus on section B. Okay, so I'm basically going to look. We're going to look at areas that are covered under standards like IAS 12. IAS 12 is income taxes, but my major focus will be deferred tax. Okay, focus will be deferred tax. Okay, so that's where I will actually be starting from. Then after that, I'll be going to Ifrs 16. Ifrs 16 is about leases. Okay, then after that, I'll be going to Ifrs 2. Ifrs 2, which is share-based payments. So that's the kind of agenda I'm looking at today. Okay. So, of course, like I indicated yesterday, it's not full-blown teaching. No, these sessions are specifically for revision. So again, my hope is that you've read these topics. You may even have been taught by your tuition providers. So our focus today will be just to do a recap on an overview, the key areas in there, and then drive down to, or immediately get to the questions based on the past paper questions. Okay, so I want us to start with IAS 12. IAS 12 is income taxes. Of course, I'm giving you just an overview. Now, here, of course, you would say that there's the bit of the income taxes, and there's the bit of the deferred taxes. My major interest is, sorry, there's the bit of the current taxes, and there's the bit of the deferred taxes. My main interest is the deferred taxes. That's what I want to look at. Okay, so when we talk about deferred taxes, that word in English means delayed. You know, you're deferring. I've delayed it. Okay, so we're saying that here, basically this arise, or first a little background. Okay, I can say this arise from temporary differences. Temporary differences. I hope you remember that temporary differences are those differences between the carrying amount of a special asset. It could also be a liability and its tax base. So that is to say the differences between the carrying amount, and the tax base of an asset or a liability. And these are temporary in nature because they will disappear. Temporary nature, as these are expected to disappear. These are expected to disappear in the future. So they are just temporary. They are not permanent differences. So in the exam, if they talk about a permanent difference, ignore permanent differences when computing deferred tax. So permanent differences will be ignored in the computation of deferred tax. Okay, so ideally then our deferred tax, the moment I'm talking about deferred tax is going to be first computed. So deferred taxes are first computed. So there are things that you go in the exam knowing that you need to have to compute and then have them recognized. So the question is, how do you compute deferred tax? We're going to base this on a formula. That formula will be the temporary differences that should be cumulative, the cumulative temporary differences. And I'm looking at this based on the reporting date. So at the reporting date, okay, times the tax rate. The examiner will always give you that tax rate. Okay, they will not leave you assume it. Now you will have to be given, or you'll have to be required to compute those temporary differences, which are needed in that calculation. Okay, so the moment, I'm going to talk about the temporary differences later, the moment you have gotten that deferred tax computed that way, then you need to recognize it. So you're going to recognize it as either a deferred tax liability, or as a deferred tax asset, if it's a deferred tax asset. Okay, so let me go back to the computation, and we need to know what types of temporary differences we have. Okay, so types of temporary differences. You have two types of temporary differences. So you have two types of temporary differences. So those include taxable temporary differences as one, taxable temporary differences. Okay, and deductible temporary differences. Temporary differences. So the question is, what do we mean by taxable temporary differences? So these are differences that will result in taxable amounts or taxable liabilities in the future. This result in taxable amounts or taxable liabilities in the future. Of course, we are talking about the future when that temporary difference reverses. Okay, when temporary differences pass. Others, what do we mean by a deductible temporary difference? A deductible temporary difference is actually a difference that will result in recoverable recoverable tax amounts or tax credits, okay, again in future when those temporary differences reverse. So this result in recoverable, okay, tax credits or tax amounts in the future when that temporary difference reverses. Okay, so in this particular case, when we talk about a taxable temporary difference, ideally, we're talking of a situation where we shall have a deferred tax liability. Okay, so maybe I should have done this. Okay, so we're saying that this will result in a deferred tax liability. Tax liability, which is presented in the non-current liabilities. So that's why you are presenting it. Okay, so ideally that means that you are going to be crediting. You're going to be crediting the deferred tax liability, the non-current liabilities. That's the credit. The debit is usually in the P&L, a line called tax expense line, except if that temporary difference results in an item that is in the other comprehensive income, in which case the debit will then be in the OCI. Otherwise, we are debiting the P&L, a line called income tax expense. Okay. Alternatively, it could be a case where you are debiting the OCI, okay, if the temporary difference works on the OCI. The temporary difference is reported or recognized in the OCI. Otherwise, the credit is always going to be the deferred tax liabilities. Okay, so mean that you have that formula, and that formula you're getting a cumulative set taxable temporary difference times a tax rate, which is always given to you in the exam. Then that formula is taking you to, so this is given as a percentage in the exam, that tax rate. So the moment you have that tax rate and the cumulative taxable temporary difference, and you've computed that, then the amount you're actually getting is a deferred tax liability. That deferred tax liability, you are crediting it in the non-current liabilities. The corresponding debit goes to the income tax line in the P&L, or you may be taking it to other comprehensive income. If the reason for the temporary difference is recognized, if that temporary difference which brought this up is a figure itself recognized in the other comprehensive income. Okay. Now, otherwise, if it's a deductible temporary difference, in this case, we are looking at a case of a temporary difference that results in a recoverable tax credit. Okay. And in this case, we are going to have this as a deferred tax asset. So this is presented as a deferred tax asset presented in the current, normally in the current assets. Normally in the current assets. Okay, so there's a rule that only that, sorry, there's a caution rule that you only recognize this deferred tax asset if you're certain or sure of future taxable profits from which it will be recovered. So IS 12 has a principle or a rule. IS 12 requires a deferred tax asset to only be recognized where the entity is certain of future taxable profits. Future taxable profits, which that deferred tax asset can be recovered. If you are not certain of future tax profits, don't even go ahead to do what I'm saying here, that you want to debit a deferred tax asset, the balance sheet, under current assets. If there is no future certainty of future taxable profits, don't do this debit entry. Okay. Of course, if you're certain, then you're doing the debit of the deferred tax asset, and credit is going to the P&L, a line called tax expenses or income tax expense. But you can alternatively credit the other comprehensive income if the reason for this temporary difference is an item that is recognized in the other comprehensive income. So you can credit the other comprehensive income where the temporary difference has been recognized or reported also in the other comprehensive income. Okay, so the case is, how do you know that this temporary difference is a taxable temporary difference? Or how do you get to know that this temporary difference is a deductible temporary difference? Because if you get to know the type correct, then you are also going to deal with the accounting entries correct, including the presentation. Okay. Otherwise, if you get the type wrong, you'll not be able to know whether you're computing a deferred tax asset or deferred tax liability. Okay. So I want to give you the tips that help us determine whether the direction of the temporary difference is a taxable temporary difference, and therefore we have a deferred tax liability, or the direction of the difference is a deductible temporary difference, which gives us a deferred tax asset. So getting to know tips to determine the type of temporary difference. Because the moment I get to know whether the type is a taxable temporary difference or it's a deductible temporary difference, all the rest just follow through. So rule one is that the moment you get to the information in the scenario and you realize that the carrying amount of an asset, say PPE or investment property, is greater or higher or bigger than its tax base, then that's a taxable temporary difference. Okay, so the moment you get to know that the carrying amount, where the carrying amount of an asset, like a PPE, okay, is greater than the tax base, that same asset, okay, then this is a taxable temporary difference. It's a taxable temporary difference. Because it's a taxable temporary difference, we are getting a deferred tax asset, sorry, liability, which leads a deferred tax liability. The moment I get to say that the carrying amount I have computed or the carrying amount I'm given of an asset in the balance sheet is bigger or higher or greater than the tax base I'm given, then I have a taxable temporary difference for which I'm going to apply the tax rate to compute that deferred tax liability, which I'll present in the non-current liabilities. Okay. The opposite is true. If the carrying amount of the asset I have or the carrying amount of an asset I've computed is less than the tax base. So if the carrying amount of the asset is not greater, in this case it's less than, okay, the tax base, then in this case I have a deductible temporary difference. Here I have a deductible temporary difference. Of course, a deductible temporary difference will result in a deferred tax asset. Okay, so that's rule number 2 or tip number 2. Okay, so I'm just going to change again tip number 1 to tip number 3. What if the carrying amount now of a liability? So you may have in the financial statements a liability. So a liability like, say, a long-term loan. We even talked about deferred tax liabilities. Okay, so we talked about, sorry, their pension obligations. Okay, so e.g., a defined benefit pension obligations. So that's a liability. If you come to realize that the carrying amount of this liability is greater than the tax base, so it's greater than the tax base. Okay, so in this case, we shall get the opposite of rule 1 again. So we shall get a deferred tax, sorry, a deductible temporary difference, and that deductible temporary difference shall give us a deferred tax asset. Okay, so here we shall get a deductible temporary difference. So that's the opposite of rule 1. So rule 2 and rule 3 are opposites of rule 1. Where rule 2, I'm just changing the word greater to less than, but I'm maintaining the asset like a PPE. So it goes in the opposite gear from a taxable temporary difference to a deductible temporary difference. Rule 3 is changing away from assets, moving away from a PPE to a liability like, say, a defined benefit obligation. So the moment I find it's greater than tax base, then I need to get the opposite of rule 1, in which case I have a deductible temporary difference, gives me a deferred tax asset. Now rule 4 is going to be the opposite of rule 3. So rule 4, which is the last, is the opposite of rule 3. So in this case, the carrying amount of this liability is less than the tax base. Is less than the tax base. If that's the case, then we shall have a taxable temporary difference, which shall give us a deferred tax liability. So we shall have a taxable temporary difference, okay, which shall give us a deductible, yes, a taxable temporary difference, which gives us a deferred tax liability. So we have 4 tips in this case. So these are 4 tips we shall use. So in this case, therefore, in any scenario in the exam, whichever scenario is given, look for whether you have been given an asset like a PPE or like an investment property or an intangible asset or an investment, okay? And check whether you have been given a tax base, they will give it to you. And then compare whether your carrying amount is greater than the tax base, you have a taxable temporary difference type, it gives you a deferred tax liability when you compute, if you apply the tax rate, okay? Otherwise, if you find that you have an asset like a PPE or investment property, but the carrying amount you have in the financial statements is less than tax base, then you do the opposite of rule 1, deductible temporary difference, deferred tax asset. So you move on in that way. And in this paper, then you can apply or you can utilize deferred tax implications on all questions or under all standards, as long as there's a change in the values, or as long as there's a monetary value for that asset or liability. Okay. So I don't know whether you have questions. Let me just double check in the chat. No, I don't see it. I want us to try out and be practical again. To try out a question that was examined in November 2022 in section B as question number 2. So my practice question that I'm using to get this point home, and it's not the only question in the scenarios, sorry, the past papers. They're quite many. I'm just picking this here, purposely for just for you to pick and take this home. Eh? So I'm looking at question 2. I think it will be part C of the November 2022 exam. November 2022 exam. Okay, so I should have picked mine already. So there it is. So November 2022 exam. So for those of you who need to download it and you don't have it by now, so you may want to download it from the Icpar website. Please look for that November 2022 paper. Okay, and I'm looking at question 2. Okay, so the question is about a company or a group called NDP Group. Okay, if I quickly run to look at, I think it's part B, not part C. It's part B then. Eh? It's part B, so let me just go and revise here to say we're looking at part B. Okay, so I want us to read the requirement first. So one part, the requirement says assist management of NDP on the calculation of the deferred tax amount arising from the acquisition of a subsidiary called KMC. Okay, so we're going to deal with the calculation of the deferred tax amount. They've not specified whether it's a deferred tax liability or asset. They're leaving you to guess. Now, we're specifically looking at this linked to the acquisition process or transaction of a company called KMC. Okay, so this is a concept. And by the way, again, maybe as we do that, just for me to emphasize that when you're dealing with these double entries, that I'm looking at a taxable temporary difference, giving me a deferred tax liability, and I'm crediting the deferred tax liability and the non-current liabilities, the corresponding debit goes usually to the P&L, income tax expense, or alternatively to the OCI, if that temporary difference is also impacting in the OCI. But we could also have a case where that temporary difference is, so that corresponding debit is going to the goodwill account. So, or goodwill account, if this temporary difference arises purposely due to your acquisition of a subsidiary and on the date of acquisition. If temporary difference arises on date of acquisition of a subsidiary. Usually this would arise from the revaluation of, sorry, the fair valuation of the net assets on that date of the subsidiary, e.g. to, this could be due fair value adjustments. Fair value adjustments, the net assets in the subsidiary of the date of acquisition. Subsidiary on the date of acquisition. Okay, so if that is the case, then we shall debit goodwill. So in that case, we shall debit goodwill. Please, normally we are debiting P&L income tax expense, but we may debit other comprehensive income if the reason for the deferred tax is a temporary difference, which is in the OCI. Again, we may debit goodwill if the reason for the temporary difference is the fair value adjustments arising from the net assets in the subsidiary on the date of acquisition. The opposite is true. If I have a deductible temporary difference, so if I have a deductible temporary difference, again, I would be debiting the deferred tax asset if I'm certain of future taxable profits, but the credit can be P&L, a line called income tax expense, or it could be other comprehensive income if that temporary difference has impacted in the OCI and therefore recognized in the OCI, but we could also have a credit that goes to goodwill. So it can go to goodwill if, like we saw up here, if this is due to fair value adjustments related to the net assets in the subsidiary on the date of acquisition. So in this case, we shall take that credit on the goodwill account. So take note of that. So as we read today's question, please be mindful of when did the temporary difference or what relates to that temporary difference. So I told you in this scenario, part B, that the following information relates to the subsidiary called KMC, and that is yet to be acquired by NDP. So it's yet to be acquired. So mean that on that date, if you acquired it today, this is the list of assets in that company, okay, which would become a subsidiary. And their carrying amounts have been given, just like the tax base has been given. We've also been given the fair values. Remember, we said the temporary difference on the date of acquisition is caused by fair values or fair value adjustments. If you remember, we've just written that here. So mean that it's as a result of fair value adjustments. So mean that we focus on the fair value side then. So there should be a fair value adjustment that has brought it up. So mean that in this case, we are going to focus on the fair value side. So go by the fair values of these assets and liabilities on the date of acquisition, not the carrying amounts. I'm going to look at the tax base and the fair value. The differences are the ones that we shall call temporary, taxable temporary differences or deductible temporary differences, and we shall apply a tax rate. So we've been given items of assets, which we shall pick individually, and items of liabilities. Okay, and they've told us that the tax rate is 30%. Okay, so we're going to compute or calculate the deferred tax, but for us to do that, we need to first compute and calculate the temporary differences. Okay, so I'm going to use my Word document, and I think I'll put in a table back to here. So I'll put in a table here. Let's see how many lines or columns they gave here. 1, 2, 3, 4. Okay, so that means that I'll also have to have 4. I don't need the one of carrying amount. I will ignore. So 1, 2, 3. Okay, 3, and then the temporary difference column, which will be 4. Okay, so I need 4 columns and as many lines. So I'm going to follow the order of the lines as given to me in the scenario. From what I see, the scenario, they started with assets. Okay, I can pick them individually. The first is PPE, where I'm looking at the fair value. Please remember that I'm looking at these 2 columns, the fair value column and the tax base column. Okay, so PPE has a fair value of 720 and the tax base is 900. So let's put it there. So PPE, first of all, I'm looking at fair values. Okay, then I'm looking at the tax base they've given me, and I'm looking at the temporary difference. Okay, so I've seen the first line there is PPE. Remember, PPE is an asset. This is an asset, okay? We've been told that the carrying amount, which has been adjusted, our adjusted carrying amount is 720, and the tax base is 900. We call this adjusted carrying amount. CA is carrying amount. Okay, so we're told that the adjusted carrying amount, which is the fair value, is 720, yet the tax base is 900. So this type of temporary difference, where I see the carrying amount of my PPE, which is an asset, is less than the tax base. From what we saw here as a tip, that's tip or rule number 2, that the carrying amount of this asset is less than the tax base. So I have a deductible temporary difference. So I have a deductible temporary difference, which you're going to compute on your calculator. So 900 minus 120 must be giving me 180. And that's a deductible temporary difference. Okay, fine. So I'm done with the first asset. Then the next asset is financial assets. I see my carrying amount is 120, while the tax base is 144. Okay, so financial assets. Okay? And we say that our carrying amount is 120, while the tax base is 144. Again, we have the same kind of we see the same kind of trade, because they're both this trend. I see they're both assets, and the carrying amount is less than the tax base. So here in this case, it's a difference of 144 minus 120. It's a difference of 24, and again, it's a deductible temporary difference. Deductible because the carrying amount of 120 is less than the tax base, and we saw that as rule number 2. We saw that as rule 2. Maybe I could put there, just for your revision, I would say rule 2 above, and also here we have rule 2. Okay, so it's rule 2. Fine, then back to the scenario. The next is trade receivables. Okay, again, we see a carrying amount of 72 and a tax base of 84. Again, it's less than the carrying amount is less than the tax base. So trade receivables. Okay, and in here we saw that the carrying amount is 72, while the tax base is 84. Similar to the other 2 above. So we have a deductible temporary difference of 12. Okay, and in that 12, we have this is a deductible temporary difference based on rule number 2. Okay, so those are trade receivables. Oh, we forgot inventories. Somebody did not see inventories in there. It's 48 across. 48 tax base, and 48 the fair value. So let's put it there. We need to pick those marks as well. So I'll put it down here. Let me put it here. So inventories. Okay, and we have a 48 across. So we have no temporary differences on the inventories. So we have a 0. If it's a 0, don't start struggling to know which type it is, taxable, deductible, no. Okay, so that is inventories. Let's also pick the next asset after receivables. The next asset is cash and cash equivalents. Okay, I have a 72 across. 72 across there. So temporary difference will be 0. So cash and cash equivalents. You still put it there. Cash, because you want to earn that mark. Examiner to give you that registration mark. Okay, so cash and cash equivalents, we had 72 across the board. 72, 72. So our temporary difference is 0. Okay, so that's cash and cash equivalents. When we go back, the next is, we now go to liabilities. Okay, the next is a liability, which is a long-term borrowing. So let's pick that as well. And the figures are the same across 120, 120, tax base and the adjusted carrying amount. So long-term borrowings. Long-term borrowings. Okay, and we had 120 across. 120, 120. So that gives us 0, 0 temporary difference. Okay, so then again we move back. After the long-term borrowings, we have trade payables. Okay, we have 84 across the lines, so there is no temporary difference on that as well. So let's put it there, and we say that long-term borrowing. Trade payables. Okay, and we're picking our 84 across. So we have no temporary differences on the trade payables, so it's a 0. Okay, so at this point, by the way, because these are liabilities, let's have a different signage on them so that we are able to get the net assets. Okay, we are able to get the net assets, for which we need to see what's the total temporary difference on those net assets. Okay, so I'm doing that also for the trade payables. It's going to be reduced from the assets to get the net assets. Okay, fine. So I'm now going to use the calculator to get the net assets figure.
Hello, sir.
Yes.
Hello.
We're waiting.
We don't use the carrying amount, instead to use the fair value.
Yes, you know why?
Or the temporary difference.
You know why?
I don't know. It is the reason why I asked.
Yes, were you with us when we were talking about anything to do with the date of acquisition of a subsidiary?
Yeah, I have
Did you
seen.
see that we said always the temporary difference will be because you had a fair value adjustment of those assets and liabilities, so we go with fair values. So the word
Yes.
There, fair values. It comes from IFRS 3, business combinations, and IFRS 10, group accounts. Okay, so we want to look at our net assets. So those net assets on the date of acquisition, in terms of their fair values, I'm going to use my calculator here, and I'm picking these totals here as they are here. Okay, so 720 plus 120 plus 72 plus 48 plus 72 minus 120 minus 84. So I have a fair value, a net asset figure, which is 828. 828. Okay, let's also do that for the tax base. Okay, so those figures in there. So I have a 900 plus a 144 plus 84. Okay, then plus 48 then plus 72, then minus 120, minus 84. So I have a 1044. So in total, therefore, the tax base total into 1044 is greater than the fair values. Remember, our fair value has become the adjusted or revised carrying amount. So my revised carrying amount of 828 is less than the tax base. So we have that difference, which is going to be the deductible temporary difference between the 828 minus the 1044. So 1044 minus 828. So I have about 216. So my total of the deductible temporary difference is 216. 216. So if I have my 216, then I'm able, in that case, I'll call that the temporary difference. In this case, the deductible temporary difference. So I'm able to get my deferred tax asset. Remember, the deferred tax asset comes from a deductible temporary difference. So my deferred tax asset is going to be the cumulative deductible temporary difference, if you remember that formula, temporary difference, times tax rate. Okay, in this case, my deferred tax asset, I tell the examiner because they want me to compute it, the deferred tax asset is going to equal to the 216. 16 is that cumulative or total deductible temporary difference times the tax rate, which they gave us the scenario. They gave us a tax rate of 30%. There it is. So 30%. So times 30%, which is my tax rate. Okay, so I'm going to use my calculator to say that, therefore, my deferred tax asset is going to equal to 216 times 30%. I have 64.8 million. So 64.8 million francs. So I've computed it. If they ask me to go ahead to recognize it, I'll go ahead and say that this is going to be recognized because this is about acquisition of a subsidiary. This is going to be recognized only in the group financial statement. So this is going to be recognized only in the consolidated financial statements. That date of acquisition, the date of acquisition, as I'll debit this in the balance sheet under current assets and I'll put deferred tax asset. Okay, so I'll have my deferred tax asset and it will be 64.8 million francs. Okay, while the credit, I'll take the credit to goodwill, not to the P&L, where I would have taken it to income tax expense. If it was on after the date of acquisition, if this temporary difference arose after the date of acquisition, then I'll take it to the P&L income tax expense or to the OCI, wherever it's relevant or applicable. Because it arose on the date of acquisition, I'll take it to the goodwill account. So anything under IFRS 3 and IFRS 10 will tell you that any adjustments you make on the date of acquisition, corresponding entries go to the goodwill account. That's the reason I'm putting it in here. So this is because as this arose at position of the subsidiary, it arose due to the fair value adjustments, to the fair value adjustments on the net assets, the subsidiary. So that's the reason that I am now crediting goodwill account. I hope you know goodwill is an asset, meaning that if you're crediting the goodwill account, the impact is that it's going to reduce the goodwill. So because you're crediting goodwill and yet goodwill is an asset, the impact of a credit on goodwill is a minus or a reduction of the goodwill account of balance. So that's the double entry. If I was asked that, the question told me that end with only the calculation of that deferred tax. The question was tricky. It didn't tell you whether it's a deferred tax asset or deferred tax liability. It just told you calculate the deferred tax amount. Okay, we see that they're telling us based on the acquisition of a subsidiary. So that word I've highlighted, acquisition of a subsidiary, is the reason that if they told me to go ahead to recognize it, I'll take it to the goodwill account, because anything that applies to the acquisition of a subsidiary goes to the goodwill account as an adjusting entry or corresponding entry. Okay, so please take note that deferred tax can come. What you need to do as a student, if I come back here, is to determine, is there a temporary difference? How do you determine that there's a temporary difference? Look out in the scenario and check, do I have a carrying amount? It could even be adjusting that carrying amount to fair value like you've seen on the date of acquisition. It could be a carrying amount the examiner will demand you compute. And is that carrying amount you're computing or given, is it for an asset like a PPE, or is it for a liability like say long-term loans, or the defined benefit obligations, or deferred income? You remember government grants. If you're using the deferred income approach, you're saying deferred income. Or yesterday I talked about Ifrs 15. I hope you remember where the contract liability, if that difference is as a result of a carrying amount of a liability compared to the tax base which the examiner will give you, then always assume it's a temporary difference. Ignore or don't assume it's a permanent difference until they tell you. If it's a temporary difference, then go ahead to determine the type. Is it a taxable temporary difference, or is it a deductible temporary difference? How do you determine the type? Use these 4 tips. You say that difference I saw, it tells me that carrying amount of the asset is bigger or greater than tax base. Mr. Examiner, this is a taxable temporary difference. And because it's a taxable temporary difference, Mr. Examiner, that temporary difference, when I apply the tax rate, I'm going to get a deferred tax liability, which I will need to be presenting in the non-current liabilities. And when I present it as a credit there, Mr. Examiner, always the debit goes to the P&L income tax expense, except, so the except starts here. I could be taking it to OCI if that temporary difference is in the OCI. Or I could be taking it to goodwill if that temporary difference is as a result of items that took place on the date of acquisition of a subsidiary, where then the corresponding entry goes to goodwill. For Mr. Examiner, this is a deductible temporary difference because I can clearly see from my tips in there that this is actually a deductible temporary difference. Okay. So I can see clearly that this is a deductible temporary difference. Because it's a deductible temporary difference, Mr. Examiner, that is actually going to give me a deferred tax asset when I apply the tax rate. But Mr. Examiner, before I rush to think and recognize it's a deferred tax asset, I need to be certain that the company is assured or certain of future taxable profits for me to go ahead to recognize. When I recognize it, Mr. Examiner, I'll take it to the current assets, but the corresponding credit always goes to the P&L, except if the temporary difference is in the OCI, I'll credit the OCI, or except if the temporary difference is as a result of adjustments taking place on the date of acquisition of a subsidiary. And therefore, the group accounts, I'll take that corresponding credit to goodwill. Okay, so if I close IS 12, just for you to refresh yourself and to take note and prepare yourself. If you did this yesterday, assuming I had done IS 12 yesterday, after having done IS 19, I would have opened the question we did yesterday. Just remember, for those of you who were with me yesterday, we did a question which was in April 2023, question number 2. In April 2023. In April 2023, this is what we did. We saw that our measure or our value of the pension obligation is 33,600, while our measure of value of the pension assets at the end of the year is 31,500. So we would have gotten the net amount. If our measure of value of the pension asset is 31,500, while the measure of the pension obligation is 33,600, IS 19 says net them off, present them as a net. So the net of 33,600 compared to the net of 31,500 would give me a net obligation. That net obligation, if they give me a tax base, let me go down there to say, or let me put it exactly here. So that we use this question we had yesterday to say that please note. Coming in here to say note the deferred tax implications. The question can come in the exam and they tell you that, can you compute and can you explain with calculations the deferred tax implications of the question above? Which question above relates to ICE 19? The defined pension scheme in ICE 19. So we shall say that assuming that one, the tax base, assuming the tax base of this pension scheme is 0. If the tax authority, let's say RRA, if the tax rules in Rwanda do not allow a recognition of a deferred tax, sorry, of a defined benefit pension scheme, okay, until pension is paid, there is. So mean that as the company kept saying that I have a pension obligation because I guaranteed to give these employees a pension after their years of service. RRA says, no, we don't accept that in the tax return because the tax laws here in Rwanda are clear. We do not recognize defined benefit pension schemes in the tax returns or in the financial statements until that very year when you're paying the pensions. Yesterday we called that settlements. That means that every year you run a tax return where your figure in the tax return for the defined benefit scheme is 000. That's the figure I'm calling that, assuming the exam told you that it's 0, because usually the countries, they will say 000 in the tax return. Please, that figure is the tax base. That becomes the tax base in our computation today. So the tax base of this scheme is 0 in the returns, while your accounting figure or carrying amount had a figure in there. Okay, and also assume a tax rate of 30%. 30% applies to this company. Applies to the company. Okay, so if this is the case, this is what we'll do as our solution. Our solution that has now
This meeting is being recorded.
So in our case, we would say that our present value of maybe a table could work better, could present better. So just to tell you that any question that comes, if there's a computation of an asset or liability, and they tell you, they go ahead to give you a tax base and a tax rate, you can get the deferred tax for that question. So they have said that our present value of the pension obligations at the year end, I think that report, that year end was 31st October 2021, which we have calculated above, which we've computed, so which we've
This meeting is being recorded.
Then I'll come in to say less the fair value of the pension assets. Again, at that reporting date, 31st October 2021, again as we have done that in the table above. So the table above, the pension assets have 31,500. I hope you can all see that we have 31,500 here. Okay, so let me take it down. It means that in this case, if I have a pension asset of 31,500, the pension obligation was 33,600, then we have a net pension obligation. A net pension obligation. Please, this net pension obligation is a liability. Why? Because this is in the non-current liabilities. So this is what ICE 19 says. Present this in the non-current liabilities. Okay, as 33,600 minus 31,500. So on my calculator, 33,600 minus 31,500, I have 2,100. 2,100. So 2,100 is the net pension obligation, and that's the figure that could be or will be in the balance sheet under the non-current liabilities. So at that point, I've used IAS 19. I'd come in to say that now IAS using IAS 12, which is my number 2. Now using the deferred tax principles in IAS 12. I need to first of all determine whether this is a taxable or deductible temporary difference. So I need to determine whether first there's a temporary difference, whether there's a temporary difference. The answer is yes. You know why? The answer is yes. So if that answer is yes, the temporary difference in this case is the difference between the carrying amount. So that carrying amount, the 2,100 is the carrying amount. In the bracket, I'll call it carrying amount, minus the tax base. So minus the tax base. So tax base is 0. So minus the tax base, which tax base is 0 because they told me it's nil. Okay. So in this case, therefore, I have a temporary difference of 2,100. My temporary difference is 2,100. Okay. Now, if I've determined that yes, there's a temporary difference, then secondly, I need to determine the type of temporary difference. To determine the type of temporary difference. Okay. Now, in this case, I'll apply the 4 tips. I'll go to my 4 tips. Where are they? They are down here. I'll come to my 4 tips, which as a student, perhaps I've carried this book or this document in the exam. And in the exam, I'll say that I have tip number 3, which I'm highlighting there, which says that the moment I have the carrying amount of a liability, in this case, a net defined benefit pension obligation, greater, it was 2,100, it's greater than tax base. Tax base was 0. Then I have a deductible temporary difference. So I have a deductible temporary difference, and that's going to give me a deferred tax asset. So let's go back up here where I'm doing my workings. So I'll come back up here to say, yes, I have, in this case, I have a deductible temporary difference. So I'll say I have a deductible temporary difference, okay? And why do I have a deductible temporary difference? I have a deductible temporary difference as the carrying amount, of the liability. 2,100 is greater than tax base. Our tax base is 0. Our tax base is nil. Okay, so this means that I have a deferred tax asset. So that's the second thing I've done as a student. The third thing I need to do is then to compute the deferred tax asset. I need to compute now the deferred tax asset. Okay, so how am I computing that deferred tax asset? I'm going to compute it by saying that, I'm going to compute it by getting the deductible temporary difference, because it's deductible, the deductible temporary difference, which now I know is 2,100. Which I know is this 2,100 here. That deductible temporary difference is there, 2,100. So I'll put it in here to say I have a 2,100 times the tax rate. Times the tax rate. Remember, they gave us the tax rate up here. The tax rate we've assumed is 30%. The tax rate is there, 30%. So I'll say times 30%. So you see, I'm this student in the exam. I'll tell the examiner that therefore, my 2,100 times 30% is 630. Mr. Examiner, here's your figure, you're looking for it. The number 4 or the last is to now recognize that deferred tax asset. Recognize the deferred tax asset. Okay, of course, you're doing this on grounds that, so this will be on condition or on grounds that the company is certain of future taxable profits. So the company is certain of future taxable profits from which taxable profits from which this deferred tax asset be recovered. The deferred tax asset will be recovered. So I want to run that double entry. Tell the examiner that if that's the case, I'm debiting the deferred tax asset in the current assets, the balance sheet. That's where it's always placed. And that will be the 630. Mr. Examiner, there it is. While the credit, Mr. Examiner, this time round, because it's not related to acquiring a subsidiary, don't cram, because now I know students are going to say, Bruce, your credit goodwill, this is what we've just seen down there. The other example you've just finished. The other example was acquiring a subsidiary. The example we did yesterday, this question we did yesterday, it was not talking about a subsidiary. Everyone's not talking about a subsidiary. We got the normal route. The normal route is the corresponding entry goes to the P&L. Where in the P&L does it go? It goes to the line called income tax expense. Income tax expense. And how much are you putting there? 630. And you're done with the story. You're only praying for the exam. For you, you're praying. I'm hoping. I wish they bring deferred tax in this paper. I wish they bring it. Look at how much I would do. Each of this is a mark, a mark, a mark. Each of those 1, 2, 3, 4, A, B, C, D. A mark, a mark, a mark, a mark. I wish they bring deferred tax. I hope we're all praying that I wish in this paper they bring deferred tax anyway, section A or section B. I'm going to kill it. You know, I have faith in you this time around. I want to have that faith. Please build it in me confidently that CPA Rwanda, for now, at least let A13 have a good pass rate because things are there. You know, when you ever get a chance to look at your own answer sheet, you know, you're here, you've not gone to church, you've not gone, some of you who are, who go to church on Saturday morning, you've not gone, I'm thinking. Those of you who wanted to go for meetings or weddings or whatever, you've not gone because you want to get these tips, but you then go and don't utilize them. And this is how the person marks. The person who's marking your script is saying this, the students say there's a temporary difference. There's a tick and a half a mark for that. And if the students calculate that temporary difference, there's a tick there. They call it a calculation tick, half a mark there. Did the student tell us what type of temporary difference is it? And if you only say deductible temporary difference, half a mark. If you justify, you say, why is it a deductible temporary difference? Then you have a full mark there. Did the student go ahead then to compute that deferred tax asset? You have half a mark there. Did the student go ahead to tell us where it will be recognized? You have a full mark. Half a mark for each of the lines. Half a mark for the debit, half a mark for the credit. And this student, why shouldn't this student be walking out of this exam prepared to have a graduation in the next month or in the next graduation? You know, you've done it. So what happens is that the examiner just says, don't do deferred tax because he knows you'll do it. If you see the question I'm doing is the one of yesterday, if they told you to do the deferred tax, okay, you do it. Now look at the one we did on revenue. Yesterday we also summarized revenue, Ifrs 15. We went ahead to do a question, if you remember. We used this same formats here, and we went ahead to do a question. That question was called Butera, okay? And we had, again, at the end of the year, we had a statement of financial position, if you remember. In the statement of financial position, we had what we called a contract a contract liability, here it is, where the contract liability is 30.9. If the question had told you that the tax laws in Rwanda do not allow a recognition of a contract liability, instead they go with the cash. If the cash was received, then that cash that was received, you know, the invoice, where's the invoice? The invoices are here, the 140. If the cash had been received or not received, that's what they go with. Then there's going to be a temporary difference. And that temporary difference will be between your carrying amount is 30.9 and perhaps their carrying amount is 0 because they go with cash that has been received. So let's also assume that again. So I'm putting another note, which is deferred tax implication. Deferred tax implications. And I'm going to pick exactly from what I have up here. That's the beauty with your papers. If you're well organized, everything is the same. You know, the students who were asking me yesterday, the question of last sitting, I would pick these very things and say, let's go and just change figures. You see, it's about changing figures. We just go and change figures. And I can assure you the students who didn't sleep yesterday, because I didn't do that question of February 2026, I didn't do this copy and paste and go and change the figures. Your examiner is expecting you to just go and change figures, especially if you've been practicing. So you just go and change figures. But if you've been just looking at the screen and then waiting for your day, then yes, you'll struggle. So let me come here and change figures. Okay, so we want the deferred tax implications for the question above relating to the contract liability now. Relating to the contract liability. In accordance with that contract liability that has arisen from Ifrs 15. So that's how the examiner is examining. He just picks and says, let me change the other and change it in terms of now a scenario which is on Ifrs 15. So again, let's assume that the tax base of this contract liability is 0. Tax base of this contract liability is 0, as the tax rules in Rwanda do not allow a deferment of that contract liability since the amount is based on cash basis. So this does not allow deferred income approach for revenues. Since only cash received and the full cash received is what should be recognized in the tax returns. Tax returns as income. So if money, so they don't go with just putting in an invoice. They want you to put what has cash received and you take it as revenue. So let's take our tax rate to be 30%. So in this case, we shall need to determine the carrying amount. In that case, our carrying amount has been given to us as 30.9. We need to determine the carrying amount of the contract liability, okay, which, as computed above, is 30.9 million. So 30.9 million francs. Okay, so then using the deferred tax principles, we need to determine whether yes, there's a temporary difference. Yes, it's there. And that temporary difference is that carrying amount, the 30.9. Okay, where the tax base is 0. Remember, they've told us that the tax law says we only go with cash basis, not that deferment approach. So 30.9. So in this case, again, we have a deductible temporary difference as the carrying amount of 30.9 is bigger than the 0. 30.9 million is greater than the tax base of 0. That means that we have a deferred tax asset, which I need to compute using the tax rate they've given me. So 30.9, applying the tax rate of 30%. So on my calculator, 30% of 30.9. I have 9.27, maybe 9.3. So I'd say I have 9.3 million francs. Okay, so I go ahead to recognize that tax asset, deferred tax asset, on condition that the company is certain or sure of future taxable profits from which this asset will be recovered. So we shall take it to the current assets and say 9.3 million. Okay, and the credit again goes to the P&L tax expense line, 9.3 million. You're done. So what you do today is to say, I pray that I get deferred tax anywhere. Of course, I'll later tell you in special cases on Ifrs 2, you don't just compute it in that way. In Ifrs 2, there's an assumption we're going to have. Ifrs 2 is share-based payments. I'm going to talk about share-based payments today after the break. Okay? So at this point, I want to hand over deferred tax to you to say, prepare for it. Highly likely it's in that paper. Let me see which questions I have in the chat. Oh, somebody is saying, which question are they currently working on? I was just refreshing the questions we did yesterday, assuming they had put in deferred tax. Okay. Oh, somebody had answered this lady. Okay, fine. So I hope you have picked the confidence on deferred tax. Okay, because it can come anywhere in the paper. Any more question? If somebody is unmuted, please, maybe it's better to first raise your hand. Is it possible this system can allow raising a hand? Yes, I think. So that we prepare you to ask audibly. Or you can write your question in the chat because I'm going through the chat. Somebody says, I don't capture the way getting 3. I don't capture the way getting 3. Okay, now I don't know where 3 is. Maybe I'm not seeing it well. He has written in the chat. So the person with techno KM, yes, your question, I'm not linking it. First, I don't see 3. I don't know where your 3 comes from for me to even try to rephrase it for you. So you've left me guessing. I don't capture the way getting 3. Okay, deductible temporary difference on contract revenue. Okay, so let's go back on contract revenue. Okay. So I hope that person who's asking, first of all, you remember, if you're with us yesterday, we had a contract liability of 30.9 yesterday, contract liability, which we said is presented in liabilities. So this company has presented it in liabilities, and the figure it has presented there is 30.9. Let's assume the scenario told you that the tax base of that contract liability is 0, because the tax law in Rwanda does not permit it in the tax returns. Yet for you, put it in the balance sheet as 30.9, and the examiner says the tax rate in Rwanda is 30% for this company. So what we've done, the person asking, is that we've taken that 30.9 and we've seen it to be the temporary difference because that carrying amount of 30.9 against the tax base of 0 gives me a temporary difference of 30.9. With 30.9, we've called a deductible temporary difference. Okay, a deductible temporary difference. And that deductible temporary difference of 30.9, we've applied the tax rate of 30%. So we've said times 30%. So in my calculator, I hope I got it wrong. 30.9 times 30%, yes, it's saying 9.3. It's 9.3. Anyway, so I don't know where your 3 comes from, but for me, I have 9.3 coming as 30.9 times 30%. So that 9.3, I'm debiting it on the deferred tax asset, because that is now the deferred tax asset I need to recognize, and I'm crediting it in the P&L, the income tax expense. So I'm hoping the gentleman or lady who has asked me using that name called Techno, I've answered you, because I've gotten the 30.9 as the deductible temporary difference times the tax rate of 30%. Okay, great. Okay, so I want to move on. I know that we need to be knowledgeable of the time. So I want now to move to Ifrs 16. Ifrs 16. I'm done with I-12. I hand you over to the examiner and exam on IS-12, but of course with prayer. It looks simple here because you're looking at me. It may look hard when you're looking at your own self, especially after today or after this weekend. It will start looking hard. You guys, I hope you know how I keep repeating that, but at times I fear that maybe you even laugh at me, that we shall not look at it until the exam. Okay, so let's look at Ifrs 16 leases. Ifrs 16 leases. I want to summarize it also. Leases. I'm picking key standards which are highly likely in that exam. So take serious note. Okay, so let me give you an overview of Ifrs 16. And the beauty with Ifrs 16 is that you have not seen it for the first time. Even in FR, intermediate level, you may have seen it before. But I do not ago. I don't guarantee that you have observed what the lecturer has taught, because you want to be last minute. You may want to be last minute readers. It's even very possible you could have read the I-16, the textbook or materials, maybe yesterday or last night or last week, but I don't guarantee that you still remember it, because you have lots of challenges as a person. You know, you're mature, you have office, you have family, you have so many responsibilities, so you can quickly forget. So these are the key issues, the tips to take note of. So on Ifrs 16, one is that be very mindful of the definition. That is, because the components of these definitions are examined. These are examined. Be very alert to that definition. People don't read to understand it. They read it for formality because it's the first sentence you find at the start of the topic. If you've understood the definition, be mindful of the accounting principles. Accounting principles for a lease. Okay? For a lease, one by the lessee. Okay? In there, especially, I would say, especially. So, especially, for example, the recognition and measurement principles, especially the recognition and measurement. Especially the recognition and measurement principles. And here, the recognition and measurement principles, look at them right from the initial and the subsequent. So both initially, both what I would call initial recognition and initial measurement, and subsequent. I hope to some of you, it's like I'm revising for you from what you're saying there. Bruce, yes, this checklist, yes, we can. We are good with it. Also, be mindful of what we call sale and leaseback arrangements. These things are regularly examined. It's even very possible that in that sale and leaseback arrangements, you could have a normal sale price, or you could have an abnormal sale price. An abnormal selling price. Meaning that selling price is above or below the normal selling price. Above or below the normal fair value that asset you're selling. So be mindful. Usually the examiner presents a situation where the selling price is normal, it's equal to the fair value. But it could be a case of a special one, that selling price is abnormal because they've priced it at above the normal market price of that asset, or they've priced it at below the normal market price of that asset. So a student who's looking at the lessee, and that lessee can come in a straightforward manner, like students doing intermediate. or can come in a special manner with a sell and lease back arrangement. That student is smart and ready for the paper. Otherwise, we could have a case of accounting principles for the lessor. So accounting principles, the lessor. Okay, so these are the concepts we are looking at. So if I'm a student, I would now start ticking or crossing that am I good with the definition, especially the components in that definition, which can be examined. Am I good in accounting of a lease by a lessee? This is a lessee. I want it to be a lessee, okay? So that you don't get confused. Okay, am I good in accounting principles for a lessor? Okay, so I think it, okay, I structured it differently. A lease by a lessee. So the lessee is here, sorry. The lessee is here, and then the lessor would be here, fine. Okay, and the lessor. Okay, please remember that for the lessor, you're looking at the types of the lease. Types of the lease. It could be a finance lease, it could be an operating lease. Okay? A finance lease, or it could be an operating lease. Okay, so let's check our memory. Okay, I don't want to take a lot of time on that definition, but just for me to remind you that everyone we talk about a definition of a lease, examinable are the keywords that I'm going to pick here. So let me pick the definition of a lease down here. So that when I talk about a definition of a lease, I'm saying that in accounting and under I-16, a lease is a contract. That contract in most cases is written, but it can be verbal. And it's a contract that passes over, what we call conveys to the lessee, that other person called the lessee, the right to use. So I'm starting to use those keywords, right to use. So that right to use an identified asset. Identified asset. Okay, so it's identified, or at times we call it specified asset. So it's identified in the contract, or it's specified in the contract, that asset, for a specified period of time. A specified period of time. I want to highlight that word specified, because they also come and look and examine it. Okay? Specified period of time. That specified period of time is what you may call a lease period. You may want to call it a lease period. Okay? In exchange for a consideration. Exchange for a consideration. That consideration is what we call a lease rental payment, or a lease rental. A lease rental. So keywords in here that the examiner can create a scenario. He wants to see whether in that scenario you're able to see that there's a right of use. And that right of use is attached to an asset that has been identified. So they make that asset so specific in the scenario. Perhaps a vehicle of this type, a Toyota, a Land Cruiser, a van, a lorry, a trailer, you know, they make it so specific, okay? Including even the number plates of engine number this, of registration number this. Then you also see the scenario that they've given you a period that is at least for 5 years. So you start seeing that, and you also see that there's a consideration. There's a consideration. So the scenario says that the lessee will pay maybe this amount every year. So the moment I see those 4 items there, then I should tell the examiner that this is a lease. And because it has conveyed a right of use to the lessee, it has identified an asset of this type or of this nature. It's a vehicle, it's a number plate of this. It has also identified the period of the lease of this number of years, And in the scenario, it's actually an obligation to the lessee to pay rent, which is a consideration for the lease. Okay, so please, minute here, our focus or our note, just to note that here, the exam will be narrative. The exam here becomes narrative to require the student analyze the scenario or the information given in the scenario. Information provided in the scenario to conclude or to justify whether or not the arrangement is a lease. The scenario is a lease, qualifies to be a lease. So you need to make a conclusion, qualifies as a lease. Okay. So it can come in that way. So usually where we are talking about a definition, don't expect more than 5 marks. But that question is usually going to be narrative. You're going to narrate, you're going to explain, you're going to evaluate. In that analysis, you're going to conclude, but supporting your conclusion, whether indeed it's a lease or it's not a lease. Because you're looking at these 4 things. You're looking at 1, in the scenario, do you see a right of use being passed over to the lessee? And usually that's going to be seen through control being over that asset being passed over to the lessee. Do we see an asset being clearly identified in the scenario as the asset being given to the lessee? Do we even see the scenarios talking of a period in there for which the lessee is going to be using the asset? And do we see the scenario indicating that yes, the lessee is going to pay something? The moment you have these 4 tests, then you come to conclude to say yes, indeed there's a lease or there's no lease. So those are the key components from that definition. Now that we've talked about that definition, let's go and look at the accounting principles of a lease by the lessee. So the accounting principles. And I'm going to summarize them so that we quickly go to a question. So accounting principles by the lessee. Okay. Please take note that everyone talk about accounting by the lessee. Ideally, you're going to have just not so many. Let's say there will be about 5 to 7 principles for you to take note of. So principle number 1 is that you're going to say that at the start of the lease, the lessee must recognize both the lease obligation and the lease asset or the right to use asset. At inception, that word inception is what they call commencement, or call the start. Now, I want to take note of the fact that we need to speak this English clearly. So at the start, the lessee recognizes both the lease obligation. That recognition of the lease obligation will be the liability and the right of use asset. And the right of use asset. This will be in the balance sheet, say here in the financial statements. So that statement is simply, a student can simply say that in here, on that date, I'm debiting the right of use asset, I'm appropriating the right of use asset, and I'm crediting the lease obligation. So that's the first thing any student in this paper should know. Even the intermediate students know that statement. Okay, the question is at what measure? So principle number 2 that I want you to remember, everyone you have a lease by the lessee, that right of use and that lease obligation is therefore at what measure? Is initially measured at what amount? At what initial measure? So that question is what I'm addressing in number 2. So I want to address that in number 2. That right of use asset. Let me start with the lease obligation. So the lease obligation, that lease obligation, you have credited, that thing that you've just credited, that crediting lease obligation is initially measured. As or at the present value. So we're going to get it as the present value of future. We put that in capital letters, future lease payments. Future lease payments. So that's the statement, that I'm getting the present value. That's what present value implies. You're going to discount. You're going to discount. Okay, so you're discounting using an interest rate in the contract. So mean that here you are discounting. So we have a discount where you are applying an interest rate, and the examiner will give you that interest rate, which is implicit, now that's inside the contract. So it's inside that contract. In the absence of that interest rate in the contract, then you use what we call the incremental borrowing rate, or the lessee's incremental borrowing rate. Please, the examiner will give you this. Never mind. This paper is not financial management where you need to compute that rate yourself. They will give it to you. So that is principle number 2. So I'm this student in the exam. I've gone to this paper and I'm praying to God that I wish I find Ifrs 16 there, because I know what is the examiner examining. Is he examining inception? Is he examining subsequent? If he's examining inception, I want to tell the examiner what I'll do in the inception. But as I do that, the question will be at what measure. I want to tell the examiner that I'm going to compute that measure by discounting using an implicit interest rate the examiner will give me times the future lease payments. Those future lease payments, the examiner can give them to you. And then you get that initial measure. Then I'll tell the examiner that for the right of use asset, number 3, I say that right of use asset, which I also had a figure here, which I'm asking myself, what is the initial measure? The right of use asset is initially measured. Okay, as, take note here, I'm going to use a table, maybe it's better. I'm better to use a table. So these are the figures that will make up my right of use asset figure. Okay, so I want to put it on a fresh page so that I'm able to see it properly here. Okay, so my right of use asset, this is what I'll do. I said again, I'll get the present value of the future lease payments. So I say it's the present value of the future lease payments, which I already computed when I was doing the lease obligation. So in bracket, I'll say same figure given as initial measure, the lease obligation above. So that same figure I gave in the lease obligation above is the same figure I come and say is the starting figure for the right of use asset, basically. And the reason here is that as I debit the right of use asset, I'm abbreviating that word, right of use asset, credit, I've taken it to the lease obligation, and that was in my principle number 1 anyway. So that figure is what I was looking for here. I have completed that double entry with that figure. I got that figure by calculating and discounting using the interest rate given to me in the exam, based on the future lease rentals that they gave me. And when I credited the lease obligation in principle number 2, I have now debited. The right of use with that figure. Then I'll come in to say plus the direct transaction costs. Plus the direct transaction costs. For example, if the examiner says that there were legal fees that were paid by the lessee to the lawyer, so those direct transaction costs, I'm going to also take them off. So I'm going to add them there. So mean that I am capitalizing them. So I paid a legal fee to the lawyer, or I paid a commission to the broker. Those brokers that take you to actually access that asset. Then I am not debiting that in the expense account. I'm debiting it as normal right of use asset. While I credit the cash because I've paid off that broker or I've paid off that lawyer. For that figure can be given to you in the exam. Okay? And I also say plus any advance payments of the lease rental or payments that have been made, rental payments that have been made before the inception date. So I'll say plus any lease rental paid on for the inception date of the lease. So at times the examiner may call it advance rent paid. So advance rent paid on or before the inception of the lease. So if on the date you are signing off the lease contract, you also are paying a check to the landlord, then you are debiting that payment as a right of use asset. So the amount of that check is a right of use asset, while the credit is cash. Okay. Then again, you are saying that plus any present value of the estimated dismantling or decommissioning cost if there's a present obligation for the lessee to dismantle the decommission in accordance with another standard called I-37, plus a present value of any dismantling, sometimes they call it decommissioning, cost, okay, if there's a present obligation. That present obligation could be either a legal obligation or constructive obligation in a standard called I-37. There's a standard called I-37, where you remember there are three conditions for you to say I have a present obligation. So for me, I have a provision for liability. Condition one is that there's a present obligation. Condition two is that it's highly probable that your own resources will be required to settle that obligation. Condition number three is that a reliable estimate of that obligation can be made. So the moment there's a present obligation, it could be legal or constructive, then the other two can quickly come in. And in this case, you're capitalizing that present obligation rather than expensing it, capitalizing it on the right of use asset account. While the credit, this time around, the credit is not cash because you'll dismantle this asset maybe after 5 years. The credit is going to be a provision for liability. Provision for liability. That credit is what I-37 says that for me, I'm interested in the credit, while the debit is an interest of Ifrs 16. So that debit is from Ifrs 16, while the credit is in IAS 37 for that one. So remember yesterday I told you that if I had time, I would have taken you through I-37. The focus in I-37 is a liability. A liability is credited. Now the corresponding debit is what I'm looking at here today, that I will take it to the asset called a right of use asset in accordance with I-16. Okay. Then you could even have an adjustment like this, the incentives. There could be incentives that you receive, especially from the incentives that have been received or that are going to be receivable from the lessor. Usually from the lessor. An example here is that if the lessor can discount or the lessor can allow, I don't know whether you've heard of cases where the rent is 500,000 per month, but the lessor says that if you're booking this building for 5 years, the first 3 months you shall not pay. That's an incentive. That's an incentive. So that incentive is going to be reduced. It's like income. It's like a bonus to you. You're going to reduce it from this right of use asset. Don't just take it to the P&L. Reduce it from this asset. Don't say I'm creating other income in the P&L because the lessor has allowed me to be in the house for 3 months without paying. There are cases where the lessor can say, I'll pay that legal fee or I'll contribute because the lawyer has helped both of us. If the amount for the lawyer is 10 million francs, I'll give him the 5 million. Let me say I'll give him the 2 million. So in that case, that's an incentive. It's an incentive to you. So that incentive, in this case, is going to be recognized by a minus. So you are going to reduce it from your right of use asset, meaning that in this case, if you're debiting it as cash, if the lessor has given it to you, or you are debiting it as a receivable from the lessor, okay, the corresponding credit is the right of use asset. This examiner can examine an incentive there. He wants to see you picking it because students are going to credit the P&L and call it other income. Wrong. Call it credit the right of use asset. Capitalize it by reducing it from the right of use asset. Most students would say credit P&L other income because the lessor has told you that I'm going to give you 2 million of the legal fees. No, because you've taken all the 10 million here, come and say minus 2 million here. So that's the whole instance. So all this will give me what we call the initial measure, the right of use asset. Initial measure of the right of use asset. So this, as a student, the question I'm asking you, as you go to this question, where we highly expect that IFRS 16 is there. If the question came in IFRS 16 and is positioning you at the start of the lease and it's asking you to give the initial measure of the right of use asset, would you comfortably pick these concepts and read and wait to see what's in the scenario and tell the examiner the initial measure of the right of use asset is, and you've computed it? Yeah. So that's principle number 3. Remember, I have to give you 7 principles and tell you that go and do your exam. 7 principles before I talk of sale and leaseback. So before I talk of sale and leaseback, I'm here. And I'm looking at the lessee, 7 things that I want you to have on your fingertips. So far you have 3 that I recognize a right of use asset and a lease obligation. The question is that who came out initially. For the lease obligation, I'll do that. Present value of future lease payments. Mean that I need to discount using a discount rate. For the right of use asset, there's quite more work to do. It's not only the present value of the future lease payments, there's even other figures put in. Okay, so number 4, principle number 4. Subsequently, I am going to do the following. So subsequently, let me put that in capitals. So subsequently, at each reporting date, in other words, every year end, subsequently at each reporting date, that lease obligation, which you had in number 2 above, you're going to amortize it. So the lease obligation is amortized. And how do we amortize it? We amortize it by increasing it with the finance cost. So we amortize it by increasing this with a finance cost. Sometimes we call it interest cost. Okay, and reducing it by this rate. So when you have finance cost, you're going to do 2 things in the exam. 1, you're going to compute it. Secondly, you're going to recognize it. I hope you're starting to understand that song, that there are things you're going to go in the exam and do 2 things: compute, recognize. So mean that when I compute, the formula I will compute here will be that interest rate, which will be given to me. That was that interest rate, which I used in discounting to the present value, times the figure called the lease obligation balance. That lease obligation balance. Okay. Now, I'll later tell you that it could be affected by whether you're paying the rent in advance or rent in arrears, but leave that alone. So the moment I've computed that interest rate, the question is, how do I recognize it? Always, I'm going to debit it to the P and L, specifically a line called finance cost, while the credit shall go to increase the lease obligation. So remember, you're crediting and liability like a lease obligation, you're increasing it. So you're starting to amortize it. You're adjusting it. The other books call it remeasuring it. Okay. Now, while for the lease rentals, you're not going to compute. Lease rentals, you're not going to compute. They will give it to you. You're only going to recognize. So the lease rentals, we only recognize. So this is only recognized. And how do we recognize this? We shall say that I am going to debit the lease rentals, so the lease obligations. So that's how I'm reducing the lease obligations, because I'm debiting a liability. While the credit is cash. This rent, or I have a lease rental payable. I've not yet paid it by the year end. So you'll read the scenario saying that it's paid or it's not yet paid. Usually it will be paid. So you're crediting cash. If you have a cash flow statement to prepare, you're going to take it under financing activities. Now I'm telling you, you could have a question 1, prepare a consolidated statement of cash flows, and there's a lease rental paid. Financing activities. You financed your operations with a lease for which you're paying a rent. It's a cash outflow under financing activities. You see, this is how these topics all link. So I7 is another one, statement of cash flows. It's asking you to categorize these cash flows under operating activity category or investing activity category or financing activity category. As a student, you know what goes in which category because of its nature. For example, in the financing activity category, you're putting cash flows that impact on the size and composition of the company's capital. And that capital is either debt capital or equity capital. So debt capital could be this form that I have actually borrowed through a lease arrangement for which I'm paying rent, and therefore it's a cash outflow under financing activities. SPAB. That student, we call him super. That's what Icpar will call that student, fine? Okay, so tip number 4, take note of it. As you take note of this, please, number 4, as you take note of number 4, remember that these lease rentals could be paid in advance or in arrears. So if they're paid in advance, it would impact on that calculation. Or if it's paid in arrears, it will impact on that calculation. So please note that the lease rentals may be paid either in advance or usually advance, it will be at the start of the year. Sometimes that's the statement they will use at the start of the year, okay? Or in arrears. When they use the word arrears, you're good, or they can say that the lease rentals are paid at the end of the year. So this is what connects. This is what connects a lease, a finance interest, and the rental. Why? Because that interest, I'll compute the interest rate. That's not my problem. The balance will be after I've taken off the lease rental if it's in advance. Or the balance will be before I take off the lease rental if the lease rentals are paid in arrears. So I'll come back here and say that lease obligation balance may be that lease obligation balance. So I'll say the lease obligation balance is after this rental paid if the lease rentals are paid in advance. If rental is paid in advance. Okay. Otherwise, that balance, so otherwise the lease obligation balance will be before. Otherwise, the lease obligation balance is going to be before the lease rental payment if the rental is paid in arrears. The rental is paid in arrears. So please take note that as you compute that figure, lease obligation balance, which balance are you going to use? It will be after you have deducted the lease rental. If you're using advance, if the lease rental is paid in advance, first take off the lease rental to get that interest. If you're computing the interest, based on rentals paid in arrears, then get that calculation of the lease obligation, get that lease obligation balance before deducting the rent. So you need to be mindful of that. So you look out, is this question telling me the rent is paid at the start of the year, or is it paid at the end of the year? To tell me it's arrears or it's advance. So that I am careful with this calculation. I'm very careful with it. We're going to do a question. You'll see what that means. Okay. So this student is saying that number 4, every reporting date, I need to amortize this lease obligation by increasing it with the finance cost and reducing it with the lease rentals that have been paid. Okay. So here it is. By reducing it with the lease rentals that have been paid. In the finance cost, when I have finance cost, I have to compute. And I need to be very careful. Am I computing based on the lease obligation after the rent, because rent is in advance, or am I computing the interest using lease obligation before the rent, because the rent will be paid in arrears? I need to be very careful there. Okay. So number 5. For the right of use asset, subsequently, it's simple. Subsequently, just depreciate. So subsequently, at the end, and I'm picking it here again. So subsequently, at the end of each year, that right of use asset, let me just create space here. That right of use asset is depreciated. Right of use asset is depreciated. This here, as we have it depreciated, we are going to depreciate it using the straight line method. Using the straight line method. Okay. And it's going to be over either the useful life of the asset or the lease period, whichever is shorter. Whichever is shorter. So you go with the shorter period. Okay, so always go for the shorter period. If the period shorter is the lease period, go with that. If the period shorter is the useful life, go with that. Now, as you do that, always remember that the moment they tell you that this asset is going to be taken over legally by the lessee after the lease period, always use the useful life. I'll say, however, always use the useful life, the assets, if the lessee is highly expected to take legal ownership assets. So if you're highly expected, if the lessee is highly expected to take legal ownership of asset at the end of the lease period, the end of the lease, then in that case, always use the useful life. So you're aware of that. You should certainly be aware of that. Okay, so mean that I'm running my depreciation, and that depreciation, I'll tell you that in this case, that depreciation charge of this asset on the right of use asset has two things again. A student to always remember. One is you're going to calculate it. So that paper, you'll not get it out without having it computed. And then you go ahead to recognize. The computer with this paper, you're going to this paper knowing which things do you have to compute and then recognize. You don't just rush to recognize. Okay? So you're going to compute it based on what you call your right of use asset divided by the years. So those years could be either lease years or useful years. So you're going to compute it. That's for this, it's so simple. Just say divide by those years. Then go ahead and recognize it. How do you recognize it? I'm debiting it in the P&L, perhaps under administration cost, and I'm calling it depreciation charge. I'm calling it depreciation charge, P&L, and the credit is the asset. So I'm crediting that right of use asset. So I keep writing it down. So in this number 5, do you realize that when you did number 3, where you initially measured the right of use asset, it was hard work, hard. When it came to now, subsequently remeasuring that asset, it was easy now. It was just that calculation. Yet for the lease obligation, when in number 2 initially, it was very easy, just getting the present value of the future lease payments. Maybe the difficult thing was to apply that discount rate to the future lease rentals and get that present value, but the life is easy there. Then it becomes hard to amortize it subsequently. Why? Because I have to do 2 things. I need to deal with the interest by computing and recognizing it, and to deal with the rent. While I do that, I need to be aware that it could be advance payment or arrear payment. So the hard problem of a lease obligation is subsequent measurement, not initial measurement. While the hard problem of a right of use asset is initial measurement, not subsequent measurement. I hope you can pick that. Some of these things I will not write them, yet I will not be there with you in the exam. Yet you may be asked to explain and advise the directors on these things. So somebody is writing that, okay, it looks like from what I see, it's hard to initially measure right of use asset compared to initially measure the lease obligation. But it's hard to subsequently measure or remeasure the lease obligation because of these too much things you have to do, compared to subsequently remeasuring the asset because the asset is simply to remeasure using that formula. Okay, so that's number 5. Please, at your level, that number 5 is where you may want to end. But let me give you 2 more things I want you to think about. Number 6 and number 7. The number 6 is that it's also possible. Ifrs also allows the right of use to subsequently measured using either a revaluation method, so mean that you don't just do that historical cost and depreciation, you can do a revaluation method, or you can use a fair valuation method. Okay, so you can revalue that right of use asset and you move away from these historical measures where you kept just depreciating that historical measure. You can choose to revalue. Usually you're going to choose to revalue in a way that is same as or similar to IAS 16. We revalue property, plant, and equipment. Meaning that if we have a revaluation gain, it will go to other comprehensive income. If we have a revaluation loss, it will go to a P&L. So it can be the same way you deal with the revaluation method in IAS 16 for PPE. Or you can adopt the fair value method, but the fair value method is only if this asset is an investment property. So this is only applied where that right of use asset is of the nature an investment property, because you're going to apply the fair value method under IAS 40. E.g., it is land and buildings. It is land and building. So you have leased a land and building, which you are subletting, which the SC is also subletting to earn income. So, you know, it's possible. I can go to town and rent as a company a building that has 5 floors. I only use 2 floors. The other 3 floors, I also rent them out and have my own income. It means that this is land and building that I've rented in town. Therefore, I'm a lessee because I'm the tenant, but I'm also subletting. I also have my own tenants in floor 3, floor 4, and floor 5. So floor 3, floor 4, and floor 5, I'll use a fair value method because by nature, they have become my investment properties. And because they've become my investment properties, I'm now using IAS 40. When I do IAS 40, I'll now start fair value every year. I hope you remember IAS 40. The fair value method means every year you're fair value. It also means that you don't depreciate them. You don't assess impairment loss. So you don't come to say, Bruce, why don't you depreciate that right of use asset? It's now fair value method. When you have fair value method of IAS 40, don't depreciate, don't do impairment loss. But every year, fair value. If there are fair value adjustments like a fair value gain or fair value loss, take them to P&L immediately. Now, in a way, I have kind of like refreshed you on IAS 40. So in this case, we shall move away from IFRS 16 to IAS 40. So where we now apply IAS 40 in place of IFRS 16. Please, this is possible in the exam. Possible. That number 6. Possible. Pick it from here. That your advanced level, you're not intermediate level. That one they can examine it. And so in your syllabus guide, you never know what may happen in this paper. Okay? Now, that is optional, but serious. Number 6. Number 7. This one is serious. Take it. That whereas I've talked about the right of use asset, I can subsequently apply revaluation model, fair value model. I also want to say that also that lease obligation, which I've amortized, I want to present it. I want to present it in the balance sheet, both in the current liability section and in the non-current liability section. So that's what I'm ending up with. I said that the balance of the lease obligation at each reporting date. Each reporting date is presented in the liabilities of the lessee's statement of financial position, but specifically under, and specifically under the non-current liabilities, under the non-current liabilities and the current liabilities. The amount that goes in the non-current liabilities